Well, one thing is for sure is that this is not the same housing market that our parents had to deal with. There were times, of course, where they had to stretch their budget, but they didn't necessarily view their home as an investment. Rather, it was a place to live, it was a place to raise a family and create memories. And of course, the hope was that one day they could pay off the mortgage, retire comfortably, they would have no housing payment. Over the more recent years, residential real estate has gained a massive amount of popularity, and we've seen major institutional investors and iBuyers into the market, while at the same time, millennials are entering their prime purchasing age. If you combine this with historically low interest rates, it has fueled speculation and created an abnormal amount of competition. CoreLogic has just released a new report indicating the areas seeing the biggest impact in the housing market correction, and the mortgage market has seen some major volatility after the recent news about these bank collapses. We're going to get into all of that and more here in today's video, so make sure that you stay tuned to the end. Don't forget to hit that like button and subscribe for more housing market content just like this. Let's go. According to CoreLogic, in the fourth quarter of 2022, the average U.S. homeowner gained approximately $14,300 in equity during the past year, while states like Florida, Hawaii, and New Jersey seeing the largest equity gains, bringing that average up, and then states like California, Washington, Idaho, and Utah actually seeing equity losses. The total number of mortgage residential properties with negative equity increased by about 6% from the third to fourth quarter in 2022 as well. And negative equity, often referred to as being underwater or upside down, it applies to borrowers who owe more on their mortgages than the home is actually worth. Even though this number is ticking up, only 2.1% of all mortgage properties are underwater, and this number is actually down slightly year on year. Now, to put things in perspective, after the great financial crisis started to unravel and unfold in 2008, negative equity actually peaked at 26% of all mortgage residential properties, and that was in the fourth quarter of 2009. Relatively speaking, very few homeowners are underwater, which is one of the clear distinctions in the housing market that we are seeing here today. To better understand what's happening in the U.S. housing market, Fortune built this heat map using the latest seasonally adjusted Zillow Home Value Index data, and this is showing the year-to-date change in home prices from market to market. On a national level, housing prices have declined 2.7% year on year, which is notable considering this is the first national housing market correction that we've seen since the housing crash bottomed out in 2012. However, it is very mild when you consider that we saw a 26% decline between the market peak in 2006 and the market bottom in 2012. And unlike the 2008 crash, this time we do not have that glut of inventory, nor do we have a subprime mortgage market crisis. Ultimately, firms like Fannie Mae and Moody's expect a peak to trough decline of around 10%, which is an indication there is further downside here in the housing market. Conversely, firms like Zillow and CoreLogic think that national home prices could actually bottom out this spring. That being said, economists at all of these firms acknowledge that the peak to trough declines will vary significantly by market. And this heat map here is a really good indication of that. So the biggest home price declines are going to be seen in markets like Austin, Boise, Phoenix, Las Vegas, and San Jose. And while many of these western and southern states continue to inch down, many of the Midwest and Northwest markets continue to rise. And the reality is that many of the home prices in these markets didn't become as detached from local income levels during the pandemic housing boom. And to drive this price home about local incomes, I wanted to give you an example of what it would cost to own a property in California. If we're taking into consideration the median priced home, which is $750,000, using a 20% down payment with current mortgage rates accounting for taxes and insurance, the monthly mortgage on that would be over $4,700 per month, while the median household income is sitting at $84,000. That works out to about a $7,000 per month income, and that is before tax. So once you take taxes out of that, you're probably sitting at maybe a net income of about $5,000. And so those numbers just simply do not pan out. Obviously, this will vary from market to market inside of California, but you can see that income is detached significantly when you look at the cost of home ownership. When you look at the median rent compared to the median income, these numbers are a lot more in line. Now think about this for just a second. If you are a potential home buyer in California and you want to buy the median priced home, you're looking at putting $150,000 down to go ahead and get a mortgage payment just over $4,700 per month, while at the same time you could potentially rent that property for about $3,000. So the recent rise in mortgage rates has created a major disconnect in the California housing market. And then if we look at a state in the Midwest like Missouri, the median home price is actually about $220,000. If we use all the same inputs, you're looking at a monthly mortgage payment at about $1,530 per month, and the median household income is $61,000, which works out to about $5,000 a month. That is much more realistic when you compare the two. And at the same time, the median rent is sitting at about $1,346 per month. So the disconnect between renting and owning is rather small at this time. And this is one of the reasons why areas in the Midwest and the Northeast are still going up in value, because they still are affordable. Now, speaking of mortgage rates, the market has become rather volatile upon the news of the bank collapses with Silicon Valley Bank and Signature Bank. The 10-year Treasury yield, which mortgages tend to track rather closely, has seen some major legs down. We started at about 4%. Now we're currently under 3.5, which is driving mortgage rates down. At the time of this recording, the average 30-year fix is sitting at 6.75%. That's down about 0.25% from where it was just 1 week ago. But based on the volatility in the 10-year, I believe that mortgage rates should actually be lower than where they are today. It's just banks and these lending institutions are scared to compress their margins a little bit because they simply do not know where the market is going to go from here. Now, I've spoken about this briefly in prior videos, but what happens in the market when financial institutions think that there is more risk or the probability of a recession goes up, then mortgage markets start to tighten and credit availability decreases. And it's already starting to unfold in the numbers. So mortgage credit availability decreased to its lowest level since January of 2003, with all loan types seeing declines in availability over the month. And that's according to the Mortgage Bankers Association Vice President and Deputy Chief Economist Joel Kahn. And he noted that the conforming subindex decreased 4.3% to its lowest level in the survey, which goes back to 2011. This decline was driven by the ongoing trend of shrinking industry capacity as mortgage rates stayed significantly higher than a year ago. Additionally, in this volatile rate environment and potentially weakening economy, there was also a reduction in refinance programs offered for low credit score and high loan-to-value borrowers. Lending standards could continue to tighten because we just saw the second and third largest bank failures in the United States history happen here in the last few days. And of course, we still don't fully understand how this will impact the housing market, how it will ripple through the economy, and whether or not there are more banks at risk of failure. However, one thing that we do know is that 60% of all outstanding mortgages were issued since 2019. And this, of course, is when mortgage rates were substantially lower than where they are today. On a positive note, that's making the U.S. housing market slightly less vulnerable. The implication for markets is that the Fed may have to raise interest rates more to get housing inflation under control and to get overall inflation back to the FOMC's 2% inflation target. Fed Chair Jerome Powell said that ongoing rate increases may be appropriate if we continue to get, for example, strong labor market reports or higher inflation reports. It may well be the case that we have to do more and raise rates more than what's priced in. According to the current market expectations for the path of the Fed funds rate, we're set to see a 25 basis point rate hike at the next March 22nd meeting, followed by a pause and then rate cuts starting in July of 2023. Now, this is what the market is expecting and pricing in, but Jerome Powell is saying something totally different. The reality is that the cost of home ownership and inflation has become a major problem for Americans. In fact, this is the 23rd straight month where Americans' cost of living has actually outpaced their wage growth, with real average hourly earnings being down 1.3%. Understand, this is inflation adjusted, so in nominal terms, wages maybe have gone up, but in real terms, meaning your dollar and the amount of goods and services that it actually purchases, is going down. So with all of the news going on in the housing market and the volatility we're seeing with mortgage rates, this is a really good time to focus on our personal financial situation. Rebuild savings where we can, increase income where we can, make sure that our credit scores are as high as possible, because with some of these tightened lending standards, it will help if credit scores are really high and we're well positioned to take advantage of opportunities when they come available. And then keep in mind that every single market is local. So while we may see continued downward pressure in markets like California and Idaho, we may continue to see price appreciation in markets like the Midwest and the Northeast. Well, that's going to wrap it up for today's video. I hope you found this information useful. If you enjoyed the content, please consider liking, subscribing, and sharing. Really helps grow and promote the channel. And also, I would love to hear from you. Leave a comment below letting us know what you're seeing in your market, and we'll see you on the next video. Take care.